3-minute trader tip. Other considerations with price action and key levels. Quite clearly, trading support and resistance levels or break through these is one of the most popular systems that traders have in place. The reason for this is quite simple. It's often easy to determine a new trend and be in there early if you have this in your trading toolbox. And so the concept is quite simple. We have a line in the sand, and if it closes above that, then that's potentially a signal to enter. Of course, we can use key levels to exit as well. Quite often when we set profit targets, we use the next resistance higher, for example, in a long trade, as our profit target. There are 3 potential considerations we want to just outline in this short session. First of all is what I would call the pending order effect. And this is limit orders going onto the market. So if there is a resistance, it's called resistance for a reason. It's had several attempts to break through that particular price level on the chart. It is the simple fact that once something reaches a key level, there's one of 2 things that can happen. Either it can break through that level, or it can move down from that level. Those who feel it might move down from that level and retrace backwards again will place limit orders accordingly to take advantage of that. So for example, below a resistance line, we may see many sell limit orders to reflect that belief that it's going to bounce off that resistance and go downwards. The second consideration is following a significant move either way, markets always look for somewhere logical to pause. Generally speaking, we see one of 2 things happening. First of all, markets will obviously look to previous support and resistance lines as a line in the sand to say that's enough for now, let's see what happens next. The second thing that often happens is we see all these resistance and support lines occurring around round numbers. We see it time and time again. And then the third consideration is what we term institutional accumulation. So how institutions trade is they'll often accumulate in periods of congestion, i.e. when something is trading between a support and a resistance line. And this is very difficult to see because institutions don't tend to buy en masse, or a big block of shares, for example. They would invest many times in a small amount so they don't move markets. This has implications, of course, for when something does break and potentially will impact the length in duration of any move. So just a couple of practical implications is on top of those that I'm sure you've already got in your plan. First of all, take care with round numbers. If you see a potential breakout at $9.95, it makes sense that $10 is a nice round number that psychologically may be important to the market. So place an entry above that round number. If we're trading an FX pair, it may be that 105 is a key number on the Euro USD. So again, if we see price action around that round number, then be very, very cautious. Same to be said for stops and, of course, profit targets. The second practical implication is potentially to give space to take out some of these pending orders. So we can do things like look at candle structure on entry and volume, but perhaps a multiple of an ATR to give us that space may be prudent, both on entry, ensuring something has actually broken through a resistance, or when setting profit targets, perhaps putting a profit target 0.5 ATR below the next resistance. So just a couple of things for you to consider there. Trade safe, and we'll see you again soon. Bye-bye for now.